Clearly, we're in some extraordinary times around this COVID-19 pandemic, or as some people call it, the Great Lockdown. It's inflicting high and rising human costs worldwide, and the necessary protection measures are severely impacting economic activity. As a result of the pandemic, the global economy is projected to contract sharply by as much as 3% or around 3% in 2020 alone. This is significantly worse than during the 2008-2009 financial crisis. Will it be a long road to recovery, or some areas of the country and the world reopen? Will we see a quick rebound? We don't know. And that's why we've gathered experts to help us make sense of it all. With that, I'd like to introduce Paul Swartz, Senior Economist of BCG. He will share his views on COVID-19 economics, disease trajectory, macro scenarios, and micro implications. So Paul, welcome. We're excited to have you with us today.
Thanks, Mike. It's a pleasure to be here and speak to you, as you said, in these extraordinary times. And I think emphasizing the degree and the nature of these extraordinary times is an important place to start. And I think while this is widely known, it can't be overlooked because it has an impact on the way we think about what comes next. And here we illustrate this by just looking at weekly initial claims. Everybody knows this, but it's helpful to see it in its long history. The peak of it was 10 times its prior historical peak. And this sort of off-the-chart break in the macro data is something you're going to see all over the place, whether it be the drawdown in GDP, which is likely to be 4 times what it was in the global financial crisis in 2 quarters rather than 6, whether it be the move higher in unemployment itself to levels not seen plausibly since the Great Depression, or whether it be just this morning, the new piece of, in some ways, trivia is the unemployment rate goes to 33%. And I think it's important to be aware that while these things are telling us something true about what's going on in the economy, they also have to be interpreted through a particular lens and not be allowed to cloud the thinking about what happens next. So it's important to think in terms of frameworks and think in terms of sort of a sequence of thoughts. And this is why I wanted to turn from the economic intensity to what I call our hierarchy of thought, where we break up this flow of thinking into 3 different categories. First comes the disease, and it's important to start here because it's fundamentally why this economic shock has been so dramatic. Because this is, I like the language Mike used of the great lockdown, I think, and that has to be the economic consequences are a function of that. So the turnaround is also going to be a function of the disease. Then once we get past that thinking, we can turn to what is the basis of the macro shock? What does the shock look like? Where are the risks and what are the trade-offs that determine different natures of shocks? And what should we be watching for? And I think it's important to distinguish this into these 2 categories, particularly so that economics can speak to what economics has a credible lens to say something about, and the more epidemiological folks can speak to what the path is in the near term. And then it's important to acknowledge and to be able to apply this framework and thinking to the micro and think, okay, well, how do I do sort of a more bottoms-up approach to thinking of, if this is either an industry sector or firm, and how does that have the potential to bubble up even to the macro level? So starting off with this disease perspective, I think I want to highlight 2 things. And the first, I think, is relatively well known. The first wave of the virus has peaked. But there are things that we can learn from this, and that there are different versions of peaks. There are different timelines for peaks, and there are different intensities. And all of that comes down to the way in which policy is able to manage in response. And And this is driven by a multitude of things, ranging from healthcare capacity to sort of governance systems and their to some extent their exposure to these types of crises in the past and ability and willingness to respond. But the fact that the first wave has passed gives some justification to think about, okay, the reopening can begin, the reopening, and what will the reopening look like? And then the second piece that is important to hammer home in terms of this this first pillar of thought is that the level of uncertainty that exists around the virus, even if in recent weeks it seems to have been trending in a positive way, remains extraordinarily high. I think, if I put this on a spectrum from what are the good things that we've seen, the testing environment has moved in the right direction. If there is a second wave, our awareness of when it's starting to emerge, both in speed, magnitude, and geography, should be much better and stronger than it was the first time around. So the risk of being caught well behind the curve should be lower. But the risk and uncertainty about the timing, the magnitude, the extent, when a vaccine ultimately arrives and when it is distributed, is really the basis for which the short term is built upon, and those things remain highly uncertain. So turning to the economic sphere, what does economics have more of a legitimate claim to be able to say something about? And I think here it's actually more significant and more credible to talk about the legacy of this crisis and what will be different coming out of this than about what happens in the third quarter per se. And I think and going back to where we started out, again, here it's important to distinguish the intensity of this crisis, which is off the chart, with what it is able to do across different areas of legacy. I'm sure all of us have heard, the claim that nothing will be the same. And I think there are elements of truth to that, but I think it needs to be clarified. What do we really mean by that? And I think dividing the legacy into these three dimensions can actually do a lot to clarify. So what do I mean by macro regime breaks, structural damage, and behavioral change? Macro regime breaks are really means of thinking about the operating system of the economy. How does the economy work? Or what is the fundamental risk distribution? Is this just a bad tail risk, or is this crisis changing the distribution of risk that we should expect to live in the future? I'm sure many of you are familiar with sort of the concept of the Great Moderation, where inflation came down, was well anchored, risk premiums were compressed, asset price valuations went up, you had longer expansions, and a tilt towards financial risks. Is that collection of structural regimes which underpin sort of a modern profile of the economic cycle, is that going to crack or change because of the COVID crisis? As a preview, my argument will be no, but I'll touch on the other two before we dip into this. What is our second pillar of legacy? It's structural damage. What is the profile of the recovery going to look like? And here it's interesting to think about. Okay, it's a shape thing, but the shape has a lot more impact on the present value of this crisis than does its intensity. And then behavioral change is that thinking about what types of consumer behavior, firm behavior is likely to be sticky, and what does that mean boiling up? And I think there we can even look for some things that may have a positive tilt to this crisis. So starting with a detailed thinking on a regime break. While there's many forms of regime break, the two most common that I hear about are fears of either a depression or a debt crisis. Now, what's interesting about these questions, or one of the things that's interesting about these questions, is that in some sense they're polar opposites of each other. A Great Depressionary scenario is not just the unemployment rate going up to 20%. It comes with meaningful, sustained deflationary pressures, which create an overhang, a debt overhang, and a crippled banking system. That's not the path that we're on at this point. It doesn't mean it's impossible to get there, but there's a lot more that needs to go wrong in a sustained way with a lack of policy response to think that you have sustained significant deflation, which bleeds into a banking sector sustained banking crisis. So why do I make such a distinction between this? Well, the Great Depression really changes the way you think the economy works. Unemployment moves up and stays there. The credit channel sort of closes down. The societal impact coming from that sustained period of high levels of unemployment is much more significant than sort of a spike up that is able to come down more quickly. But what about the debt crisis? And another legitimate question, but sort of coming from the other side, is, well, shouldn't all of this debt sort of lead to concerns about sustainability, concerns about the dollar, and concerns about inflation? And here it's important to acknowledge that, again, the capacity for stimulus is far less linked to debt levels itself than it is linked to the conditions which underpin the ability to finance. I guess not so much the joke, but the reference in the global macrosphere is the negative view of Japanese debt being sort of a widowmaker for the past few decades. Well, why is that, or why is that capacity so great? Japan certainly has a number of unique features about it, but one feature that's extremely strong in the U.S. is that nominal interest rates are meaningfully below what you would expect nominal growth to be in the medium run. And why does that matter? Well, they're in conditions where nominal rates are below nominal growth rates. There's no need to use real resources to finance the existing debt stock. That doesn't mean operating deficits that are linked to demography aren't a challenge that needs to be tackled, but it does mean that the spiraling of debt from a crisis perspective is much less plausible. And I think on the next slide, I point to two things of saying these fears are overblown. Are these fears, the deflationary fear, how do you get that? You get that from a inadequate policy response. And if there's a silver lining to this crisis, it's the speed and magnitude with which policy was able to respond. And on the debt side, the underpinnings of a healthy financing regime, sort of, to the extent you can observe it, is probably best observed with what happens to rates when there's a risk-off episode. And that still remains, that sort of negative bond equity correlation still remains quite and strongly negative, suggesting that the dollar and certainly the federal government perspective has a meaningful amount of capacity to try to offset this, and that the crisis is actually enhancing that capacity rather than stressing it. So if there's little impact, or the road to impact in the macro regime is very narrow, where is there impact? And I think this is in the second pillar, is where you start to see material impact. And this is about the shape of the recovery. When we get past the disease and the recovery begins, what type of recovery do we have, and how do we describe it? And from an economics perspective, we like to use this V, U, and L language, which is a little dicey because it seems as everyone uses it in their own way. But we're using it in a very particular way. A V-shaped recovery in our terms is not about it being mild or it being short. but that when the recovery comes, that you return to your pre-existing, your prior growth trend. So you only have sort of a pocket of loss in terms of present value. So the present value loss, even in a material shock, if you can make it all the way back to your pre-existing trend, is relatively minor. The U-shaped crisis is where growth goes down, but when growth resumes at the pre-crisis trend growth rate. And you see that parallel growth in economic activity. That is a much more dramatic impact in terms of the value of economic output. And then as a more extreme case is where not only do you have the drawdown, but your underlying potential is damaged. And this is not, these shapes are not something that, you know, we've sort of simply made. They're not simply theoretical. You can see them in sort of real-time examples in the past. I'm sorry, I'm skipping a slide here. Oops. When you looked in the last crisis at Canada, the US, and Greece. And, you know, what were the drivers between these three things? Well, Canada was largely able to escape a financial crisis and, basically speaking, return to that pre-crisis trend. The US, classic form financial crisis, when growth resumes, you're looking at a growth rate that is very similar to the pre-crisis growth rate, but there's very little, if any, recovery towards that old trend. And then Greece, we use as that more systemic crisis that even when growth returns, it returns at a much more subdued pace. And I think to illustrate the meaningfulness of this, even if it doesn't tell you about when the timing of this crisis is, if you think about what the economic output loss relative to the pre-crisis trend in the US from over the last 10 years is about $15 trillion. If you'd been able to recover even in a very, very prolonged V, where you took a number of years to recover, you would actually have only seen about $5 trillion worth of lost output. So only about a third, even in a severe case. So the question about how you can make this more of a V than a U is actually, I think, the critical question for the recovery. And flipping back to this, you know, our own thinking on this is the V-shape is too much to be hoped for. The crisis is too broad, too deep, and sort of too severe, and not to do some form of lasting damage. But the U-shape, where you see no bounce back, is also too negative in outlook. The idea that you see no recovery or you see no bounce back towards trend is also too dramatic. So what should we be using to think about this sort of battle between the U-shape and the V-shape? And I think this ultimately comes down to a battle of policy. There was, you know, the healthcare policy was necessary to contain the virus. The economic policy was rather impotent in its ability to offset that containment. But when we think about the economic policy ability to offset or demur structural damage, which is what gives you that more impactful U-shape, is actually quite significant. And again, that silver lining of the severity and speed of this crisis is that the policy response has been, in terms of magnitude and speed, almost unimaginable. I like using, you know, in the U.S. the example of if you'd asked me in January, what is the chance that in the next crisis we see systematic mortgage deferments as a means of policy stimulus, I would have sort of scratched my head and said that seems almost implausible, given, you know, the last crisis was about mortgages and you couldn't get it together then, and in a matter of weeks that was rolled out and had wide uptake. Now, the policy challenge is tremendous for a couple reasons. One, or first and most immediately, it's sort of the impetuosity in a time of shutdown. So, earlier on we mentioned the savings rate has spiked to 33%. Why? How is that possible in a time when you're seeing mass unemployment? Well, retail spending has collapsed and stimulus money has been delivered into pockets. But unless that stimulus money can be spent, its ability to forestall some of this economic calamity is relatively modest. But what you want to do with this is get money into the places, the firms, the households that are credible, what I'm going to call going concerns, that when they are able to reopen the doors, they can do so. So, this is, the classically, this type of crisis, the speed and intensity is usually a financial system thing. And we're talking about the moral hazard associated with bailing out the banking system. And from an economist's lens, okay, moral hazard is bad. In normal times when the systemic implications are low, you want to sort of impose the moral hazard cost. In crisis times when the moral hazard costs are extraordinarily high because of the perpetuation of systemic damage, you really don't want to impose that moral hazard, and you want to be engaged in mass liquidity provision and capital where there need be. Well, this crisis is unique not just in its magnitude, but in the fact that those types of what are traditionally sort of financial sector responses were needed in the real economy, not in the banking system. And that playbook is not well crafted and well built for the real economy. So a lot of this had to be built on the fly. But the encouraging thing, while perhaps not designed perfectly, a lot has been done to try to mitigate that. So what would one want to watch to see if this crisis is becoming more of the U shape and less of the V? I think it's really about whether you want to look to see if there's underlying structural damage. Watching the data flow from a timely perspective is helpful, but it's not going to tell you a lot about the degree to which the recovery can be sustained. It's going to tell you about what's happening right now. And my three lenses are, there's more than this, but the three I'm showing here are, the question is this becoming a financial system crisis? Is there liquidity concerns? Is there capital concerns? Are there sort of, is credit not flowing in a way that I would expect? And, very early on, you saw hiccups in the commercial paper market, and then the Fed, took out its arsenal and unloaded and then reloaded and unloaded again. So their commitment to sort of roll out the traditional monetary playbook is obviously quite substantial. And I think there's a lot of reasons to argue, it's clearly not a financial crisis now. And there's a lot of good reasons to believe that it shouldn't become one. But that's an area to watch in this V versus U's battle. I think the second piece to watch is there damage to the supply side factors of the economy, labor, capital, productivity, for my economist friends in the crowd. And I think the key piece here is, what is the capital base doing? Is investment being deferred and delayed to a degree and magnitude where my belief is that potential is being impaired? And I think you're starting to see it. It was particularly severe on the transport side. Ex-transports, it's at least reported to be less severe. I think it's also wise to be aware of the challenges of even collecting this data in this time. But at this point, you're not seeing sort of a collapse in investment, and you're not seeing the underlying conditions where you believe a collapse in investment should be sustained. Again, if you can keep those firms and households as going concerns. And I think obviously another metric to watch here is sort of the degree of bankruptcies. If you see bankruptcies, particularly bankruptcies that you wouldn't have thought plausible before the crisis, I think bankruptcies in the retail space, bankruptcies of sort of highly levered entities that were always plausible before, while not encouraging, is not the type of thing that really terrifies me. What terrifies me is sort of the the mom and pop, small and medium-sized firms that are closing up, where these were businesses that were before credible and would be credible in a reopened economy. And I think obviously the PPP program has done a tremendous amount to try to provide a bridge over that. If there's a silver lining to this, I think if you look at the unemployment data, while unemployment has surged higher, the component of it that is being labeled as temporary, and there's some complexity to this and how it's measured, has also surged higher. Nearly all of the unemployment that we've seen on a monthly basis so far is classified as temporary. This is the opposite of what you saw in 2008. In 2008, the share of temporary unemployment, you can't really see because of the way the axis has been broken. But the share of temporary unemployment in 2008 went down, not up, as the unemployment rate spiked. If policy can keep these firms who believe their layoffs are temporary in a shape to reopen and rehire, the prospects for a very rapid recovery, unlike what we've seen in the prior 3 recessions, more like something you saw in the early 80s, actually remains quite good. And that I think that's why I describe this as sort of a policy battle between the U and the V shape. And then quickly on this last pillar of change, I think this is about thinking, from a market's perspective. This is sort of the bottom-up view, thinking about what are the microeconomic changes that could persist and stay. Everybody's talked about what is this going to do to commercial real estate, demand, how are offices going to be set up, what will this do to business travel, will we be flying for, will we be doing the business lunch in Chicago and fly from New York, or is that now acceptable to do on a Zoom call? And how many of those things will be sticky? And those all have the potential to sort of add up to particular challenges. And I think the V, the U, and the L, thinking in terms of structural damage from behavioral change, is an appropriate means or an appropriate framework to think about industry and sector change. But it's important to acknowledge that the macro shape is not a micro destiny. The micro destiny will be determined by its own idiosyncratic factors. But I promise to end on a somewhat positive note. And here, I'll just show a picture from a macro perspective, which is just highlighting where productivity growth has come from on an economic sectors basis over the last, I guess, 60, 70 years. And you can see one of the big drivers of why productivity growth has come down and why trend growth has come down from a productivity perspective has been that the sectors with high productivity growth have shrunk. And this is really about the old goods side of the economy getting smaller. And in part, it's actually driven by that productivity was higher. And the more services side, healthcare, education, hospitality, finance, those have gotten bigger as a share of the economy, but haven't improved their productivity profile. So you add that all up and you get lower productivity. Well, can COVID be a positive catalyst for some degree of productivity growth if these services, education, healthcare, find a way to learn something out of this crisis, particularly in terms of digital adoption, whether that be sort of teledocs that can improve the productivity of a doctor in a healthcare system, whether that be some adoption of an electronic platform for education that can help control costs in both those sectors. While it's not transformational, I think I think it's not unreasonable to think that there is a chance for some upside in the productivity side, and if that service sector productivity thing could be cracked, that's very meaningful in terms of changing very low trend growth. Again, I don't want to make it sound like this is a revolution, but I think there are elements and pockets where you can think that this has the potential to have a positive legacy in what is a very gloomy and challenging era. I highlight here a few of our publications if you're interested in a few of our public publications, if you're interested in reading a little bit more. either on the Bruce Henderson Institute here at BCG or a few that have been published in Harvard Business Review. But with that, I will turn it back to Mike to see if there are any questions.
Paul, thanks. That was fantastic. And yes, there are quite a few questions. We had several that had come in even prior to us launching the webinar today. So I'll go to those first, and then we've got quite a few thereafter. We'll get to as many as we can. And as we committed at the outset, for those that we're not able to get to in the course of this conversation, we'll look to see if we can't get some written response back to the broader audience. A couple of the questions that had come in ahead of time. What are the risks of global interest rates rising, not because of inflation, but because of fundamental repricing of risk to reflect the true risk in the global economy? And I'm assuming that's in light of the last 60, 90 days. What's the potential impact on the interest rates?
I think it's a good question, and I think to a certain extent you've seen it, but you've seen it in the risk end of the spectrum. And I think the heart of this question goes to, could we see a repricing of risk in the quote-unquote risk-free part of the spectrum, really that sovereign paper, and you're talking about treasuries as sort of that cornerstone of that environment. And I think that's really related, in my own mind, to that macro regime. I think it's very difficult to see a move higher in core interest rates without seeing a move higher in inflation because of the ability and willingness of the Fed to respond. And then you have to think about, okay, well, what would constrain their ability to respond? Weakness in the dollar, but that would have to be accompanied by problematic inflation, in my own mind, for that to happen. So the hurdles for that type of systemic repricing of the base rate, I think, are quite high when there's willingness, ability, and a policy framework that is geared towards providing nearly unlimited liquidity.
That's helpful. Next question was, you and I, before we even got on the air, were talking about some of your experience and the demand for your time amongst boards across the globe. What are you hearing from them? How are they feeling about their risk, the impact on these global businesses? Very specifically, the question was asking about the ability of these businesses to pay down their debt. And I'm assuming you alluded appropriately to those who were probably teetering on the edge in the retail sector in particular prior to this event, but more broadly than that, businesses that back in January and February were probably doing quite well. What's the sentiment in the boardroom and confidence about their ability to pay off debt that they may have?
So I'll give you my own view. I haven't you really gotten into that topic before, but my own view is really related to, I think, people who are in a position to invest and feel that their balance sheet is healthy and their liquidity profile is healthy. They're looking to find a way to get comfortable and find the right investments. And I think that ranges, and I think, I think we've all heard examples of industries or sectors that are plausibly consolidate out of this. I think a primary one being the hospital systems. And I think the strong hands in those ecosystems are likely to try to look at this as an opportunity to take advantage of that and scoop up weaker hands. And the weaker hands are trying to find a way to survive and really, that's goal number one, number two, and number three for those weaker hands. I think from an investor perspective, if I was watching this space, certainly defaults are going to go up. They're already beginning. The question that I pose and that I have for myself is: are these defaults that sort of was just, is this just an acceleration of a trend that I thought was going to happen anyway? And I think that's really sort of the retail thing, to a certain extent, some of the highly leveraged pieces, or is this breaking into sort of closing firms and breaking the balance sheets of what should be healthy businesses and firms? And I think policy is the key there. And I think I'll give you my own version of what I fear most, is that we've met the policy challenge in the first round of the disease, but if the disease comes back in the fall, late fall, but it comes back mildly, regionally, and it comes back in a way that doesn't sort of facilitate the divide of politics to generate a meaningful policy response. And then you start to see bankruptcies of more substantial firms that shouldn't have happened, and impairments of balance sheets that shouldn't have happened. And that's when you're drifting into that more sustained U-shape. But I think there's a mix. There are folks who are looking to survive, and I think there are folks who view this as an opportunity, and are trying to figure out and grab hold of something in an extraordinarily uncertain environment to take advantage of that.
This next question that came in, I think, was specific to one of your early slides regarding the unemployment figures that you were showing, and whether or not the 2008 figures and some of those that you were including relative to today include furloughed employees, or was that yet distinct from the numbers that you were showing?
So one common thing that people will do is show broad unemployment. And the reason I don't show that is because I don't have the sort of cross section with that temporary tagging in those measures. But I think the theme holds true in that those who are furloughed. I believe those who are furloughed should show up as unemployed in the headline measure, but those who are captured in the other measures, who say, to the survey taker that they're not looking for work and are non-participants, even though, they're not looking for work because they can't go outside. Those are in the broader measures, and I think those are certainly higher. I think, the marginal data point on unemployment of continuing claims coming down yesterday was quite encouraging. I think it'll feel really a lot more encouraging if that happens again next week. But that incremental change towards, okay, there are signs that belief in its temporary nature is true, is really the key to whether we can mitigate the structural damage on the employment side. Yep. If that answers the question.
I believe it does. This next observation and then question that follows, I think, is one that many of us have been wrestling with, and it speaks to the departure of what we're seeing in the broad market. I'm assuming this person's referring to the equities market in particular, relative to the business conditions that we're seeing and experiencing kind of firsthand, and this seeming divide between how the markets are behaving and the conditions that we're seeing on the streets with, doors shut, unemployment where it's at. The ultimate question in that being, do you feel as though we're headed for a major correction?
Yeah, it's a great question. And I sort of two key pieces in my own mind. And I'm very sympathetic to the view that the rebound seems remarkable. But when I think about it in two ways. One, I think the degree and speed of the sell-off is somewhat reflective of what I like to call the regime of modern volatility. This is the way markets in equity markets in particular tend to behave for the last 20 years. I mean, I guess maybe the birth of this era is 1987. Whether this is in part due to the rise of passive and less elastic investors, in part this is the rise to sort of the financialization of the economy and sort of the tail risks that come with that. But when we see sell-offs, they happen faster, and they tend to have sort of a feeling of a priced-in liquidity risk, even in the equity market, which gives you sort of these overshoots on the downside. And I think that's part of the explanation for a strong rebound, at least its initial stage. And that certainly feels the way each of the drawdowns, I think, in the last number of years has felt. And I know that this drawdown was the fastest bear market on record, and I suppose that the recovery is, while not in total, is competing for a record as well. The second piece of that, and this is a little bit more of a valuations angle on it, is the equity market is obviously much more concerned with the legacy of this crisis than it is with its current conditions. And this goes back to that idea of the global financial crisis, chopped out $15 trillion of economic output relative to the pre-existing trend, not because it was a deeper drawdown than this was. This will be a far deeper drawdown in output terms, but because when growth resumed, it just resumed at its old slow trend rate, and you just sort of clicked along. The equity market is sort of taking that present value, that present value of all that future output, future cash flow, future earnings, and saying, okay, is this recovery one where I get back most of the way to that trend path, or is this one where when growth resumes, it's going to be really mild? And I think this year earnings it seems like the equity market is kind of just looking past them and saying, okay, I'm looking forward, and I think there are other elements to this. Some of this crisis probably favors bigger firms with access to deep liquidity. That's what the equity market is made of. It also probably favors tech. Tech is a big weight. Obviously you can look at the difference between the NASDAQ and the S&P, and as shocking as it is, the NASDAQ is up for the year. So I think there are some. I think the first two I talked about are more macro reasons about why this recovery has looked like it has in equity space. But I think the profile, if and when there's a second wave, and we have to struggle with that, certainly that's going to that will re-inject uncertainty and be a challenge. But the equity market, I think, will still look not every day, but will tend to look towards that horizon.
Very helpful. Pivoting to different assets, specifically precious metals. Any views on outlook specific to precious metals?
I know this is a very passionate topic for a lot of people, and it's a fascinating one. And I'll highlight that precious metals have a challenged role in portfolio construction, just because they don't have sort of for lack of a better expression, a yield. So my expected return, at least my own personal view on this, is that I have to sort of accept that my expected return on precious metals in real space is probably very small. But that doesn't prohibit it from being legitimate, certainly tactically, or legitimate strategically on the basis of portfolio construction. And then it's a question about what type of risk are you trying to hedge, and what are you willing to pay for that risk, and is this the right way to hedge that risk? So I think there's a lot of I've made the case that I think sort of a macro regime break to higher inflation, to a problem with the dollar, while not impossible, is a very challenged path. And certainly that would be an environment that would be very good for gold. but I think the question then becomes for portfolio managers is, okay, how do I construct that hedge? And this is the right way to hedge it. Tactically, I think there's, I'm not a commodities expert, but I certainly the likelihood of a low interest rate environment for an extended period of time does bring back that tactical trade. So the reduction of the carry cost certainly makes that more of a live tactical thing.
So this next question is a Milton Friedman reference, and so I'm going to read it verbatim and make sure I get it right, because this poli-sci major will be well outside his depths quickly. Revisiting the Chicago plan's proposal for 100% reserve banking as a means of dealing with the debt issue, public and private debt levels, before it leads to depression-like trends. Any thoughts on that? I think it was a 50s era proposal that he had put forward.
So it's an interesting question, and it's not. My own view would be that the sort of the hard monetarist school, with a touch of sort of the Austrian economics school folks, have a lot to offer in terms of their management of risk. And I think if you want to think about what this does, what you're doing is you're really tamping down the prospects for financial crisis of a variety of kinds, which certainly is attractive. But what you're also doing is materially constraining your ability to respond to other types of macroeconomic shocks, fiscally, monetarily, and even just sort of a credit cycle. So my own view of it is there's a positive feature in that I believe that operating model brings with it a much lower level of financial system risk. However, my own view is that transitioning to it would bring so much financial risk from where we start that I don't see how it could be done. And even if I could see a way to do it, it's not obvious that a world of pseudo gold standard like monetary abilities, where I believe I have more frequent cycles but potentially less dramatic, is better in all ways. So I think, at least my own view is, it has to be sort of acknowledged that there's a trade-off in sort of operating models. There are pluses and minuses to each, but from the place that we start, I don't see a plausible way of getting there without incurring an enormous amount of pain and risk that almost certainly isn't worth that sort of transition. So a fun intellectual debate. If anything, I think the political realm and the policy, the culture of stimulus prohibits that as a political possibility. And if anything, we're really moving in the opposite direction.
Interesting discussion regardless. Question on the savings rate that you referenced earlier, 33%, if I'm not mistaken. The question was, does that include repayment of debt?
So yeah, there's a bit of a sort of a macro accounting question. Any acquisition of assets, which would also implicitly be a reduction of liability, would be included as savings. Savings from a macro perspective is really sort of disposable income minus spending. Anything left over, regardless of what you do with it, should be part of that savings rate. And for what it's worth, what's happening with the savings rate is that the stimulus checks have been delivered, but nobody's able to spend them. So you saw an epic rise in the savings rate and an epic fall in retail spending. And that level of the savings rate won't be sustained, because the top line income piece, i.e. the stimulus checks, won't be delivered again next month. And then it's a really question of where it settles in terms of what and to what degree, what forms and to what degree the spending piece is able to come back, and how much is left in terms of income loss.
Yep.
But yes, payment down of debt would be included.
This is a question I know has come up even socially over glasses of wine on the weekend. The behavioral and economic impact of 2/3 of laid off workers temporarily receiving more money in unemployment benefits than they were receiving in the job from which they were unemployed.
Mm-hmm. So it's a great question, and it's certainly a hot topic. And I'll give you my own few thoughts. And personally, I was very interested to see typically this is a lower income thing, but it is not always a lower income thing. My younger sister, who is college educated and perhaps listening to us right now, also ended up she was put on half wage, which allowed you to apply for unemployment. And she ended up making more on unemployment than she would have regular working. Fortunately, she's back at 100% capacity, and she was actually very eager and happy to go back. But I think it's a good illustration of a few things. One, the challenges of setting up this type of policy to deal with a real side shock is unprecedented in magnitude and size and scope. And it's almost inevitable that there's some leakage, which if you designed it with time, care, and planning, you just wouldn't do it this way. And I'd like to think that most people would agree that if we design this preemptively and more thoughtfully, and maybe this is a case to do that, that it wouldn't have looked this way. Their policy proposals have been floated for sort of a hero's check, so that people who actually continued working didn't. The other thing, just to say quickly, I think some people have the concern that, okay, well, if people won't want to come back and work, and then how do you get the economy restarted? My own reaction to that is, if that's the case, I'm delighted by the form of problem we have. That's a really nice problem to have, because it will self-resolve, and that this is only for a certain number of weeks, and it's indicative that we've had a really resilient recovery, where that sort of demand for that high contact, low income service sector worker returned, almost entirely. So it's an interesting debate. I think it's really an admission that the policy wasn't designed as well as it could. I think it's more important that the policy get done and get out than it be perfectly designed. And that if this is sort of a problem of remobilizing labor, we've ended up actually in quite a good world, and it will self-resolve on a relatively short order.
Next question, you made some observations about the possibility that in the areas of healthcare and education, that perhaps this will lead to greater digital adoption. And this listener was asking if you could expand on that productivity growth was low for education. And speaking to that a little bit more, what are your observations specific to education, and I guess I wouldn't go too far out on a limb here, but from a productivity gain standpoint, leveraging digitization, could you expand on that?
It's a great question, and there's a lot of details to how this would happen that are challenged. But if you think in healthcare and education, why has productivity been so low? Well, it's in part because it's a very human-intensive business. And that's a big part of the cost base. And those wages, it's highly educated wages. Those wages tend to grow above inflation, and thus, unless they can sort of ramp up their output, which is challenging in that high touch, going into the doctor's office, how many kids in a classroom world, it's challenging to see productivity. So what can digital do to sort of crack into that. And I think computers have been in the classroom for decades. But how can they be used and utilized to sort of lower the cost base of education? That's where you would see the potential for real productivity gains. And I think my favorite example or most plausible example in my own mind is, can this crisis sort of crack the hold that the university education system has on some of the sort of lower value-added, less specialized classes? Can you do some of your general electives at your university rather than for $5,000 a credit hour? Can you do it for a couple $100 in a mass online open course and sort of test out of that? I think there's a lot of it's not just a technical challenge. I think this crisis has given education platforms and healthcare platforms the opportunity to demonstrate what they can do, which opens up the possibility that we can overcome some of the cultural challenges and sort of institutional challenges of acceptance of these technologies as viable means to deliver some of that healthcare and educational value. So there's certainly a lot of work to be done, but perhaps this has the potential to accelerate some of those trends. I think everybody likes citing the Alibaba example of that, the digital uptake of online spending in China. Alibaba cites this in their own corporate history as really being aided by SARS. And people locked in and then said, okay, well, I'll try this online thing. And then said, oh, I actually like this. I think there are more institutional challenges on the healthcare and education side, but this has certainly been a demonstration of what they can do.
Yeah, that's one I can personally relate to. I know in the heat of the lockdown, just the amount of deliveries that were coming to our door for things we would have otherwise gone out to get. And I don't think the pattern in our household is going to change just because of that. It's exceptionally convenient. Good news, bad news. Good news is we've had a highly engaged audience with a ton of great questions, many of which we didn't get to. So as we had committed at the outset, we will look to get answers back to all those that we were not able to get to. So thank you very much to those folks that have asked those questions, and when we get back to you. I got a couple closing comments. Paul's presentation leveraged many data sources, notably DataStream, which is Refinitiv's historical financial database with over 35 million individual instruments or indicators across all major asset classes, including 8.5 million active economic indicators. It features 65 years of data across 175 countries. If you've got any interest in that, drop us a note, speak to your account manager.